Is investing in AI stocks a smart move right now? Or are we just fueling the next big market bubble? Today, I'll break down why some experts say you should still invest in AI, even as bubble fears grow, and what could shift the entire game for the stock market. Let's get right into it. The artificial intelligence boom isn't just hype. It's been the driving force behind much of the stock market's recent gains. Name any big winner over the past year, and chances are AI had something to do with it. Tech giants like Nvidia, Microsoft, and Alphabet are all riding high on AI optimism. In fact, if you strip out the gains from these AI-linked stocks, the broader market would look a lot less exciting. But here's where things get interesting. Oh-Sung Kwon, chief equity strategist at Wells Fargo, isn't denying that there's bubble risk in today's AI trade. In fact, he's saying, yes, there's a risk, but you should still put your money into AI stocks. Why? Because the AI rally could keep powering ahead for one simple reason. There's not much else driving the market right now. Let's unpack that. Traditionally, stock market gains come from a wide range of sectors. Think banks, consumer goods, energy, and more. But lately, those old standbys haven't been pulling their weight. Some sectors are even dragging the market down. Manufacturing, for example, has struggled as interest rates have stayed high and demand has cooled off. Retailers have faced mixed results as consumers become more cautious about their spending. Even some parts of tech outside of AI are just treading water. So, with so many sectors stuck in neutral, AI stands out as the clear leader. According to Kwon, AI is dominating because it's delivering real, tangible gains, both in business productivity and in market returns. Companies using AI are finding ways to cut costs, speed up processes, and unlock new revenue streams. Investors love that story, and money keeps pouring in. But let's address the elephant in the room: bubble risk. If you've been around the markets long enough, you know how this story can end. Remember the dot-com bubble of the late 1990s? Back then, any company with .com in its name saw its stock price soar, even if it didn't have profits, or sometimes even revenue. Eventually, reality set in, and the bubble popped, wiping out trillions in value. Is AI the new .com? Not exactly. There are some important differences. First, many of today's leading AI companies are already profitable and have real products in the market. Nvidia, for example, isn't just selling a dream, it's selling the actual chips that power AI models at companies all over the world. Microsoft is weaving AI into its cloud services and productivity tools, generating billions in new business. That's a far cry from the speculative bets of the late 90s. Still, valuations are high, sometimes eye-wateringly so. Nvidia's price-to-earnings ratio recently topped 70, meaning investors are paying a hefty premium for future growth. That kind of optimism can work as long as the growth keeps coming. But if the AI sector stumbles, stocks could fall fast. Here's where Kwon's point comes in. Until the rest of the economy picks up, the AI trade is likely to stay strong. He argues that investors should lean in to AI, but be aware of the risks. In other words, don't bet the farm, but don't sit on the sidelines either, because right now it's AI or bust for market gains. Let's talk numbers. In 2023, the so-called Magnificent Seven tech stocks, most with heavy AI exposure, made up over 60% of the S&P 500's total gains. That's an enormous amount of concentration. For context, in a healthy bull market, you'd typically see strength across a wider range of sectors. This lopsided dynamic is what has a lot of analysts watching closely for signs of trouble. So, what could change this picture? Kwon says to keep an eye on the more beaten-down areas of the economy. If sectors like manufacturing, energy, or consumer goods start to show real improvement, maybe because of falling interest rates or a pickup in consumer demand, then investors might rotate out of AI and into those lagging sectors. That wouldn't necessarily mean disaster for AI stocks, but it could slow their meteoric rise. It could also make the market's performance more balanced and less dependent on a handful of tech names, there's also the wild card of regulation. Governments around the world are starting to take a closer look at AI. From privacy concerns to potential job losses, new rules could slow adoption or change the business case for some companies. That's another risk for investors to consider. So, where does all this leave the everyday investor? If you're thinking about jumping into AI stocks, consider your risk tolerance and your time horizon. Diversification is still your friend. It's tempting to chase the hottest trend, but remember, even the best stories can hit a speed bump. Some experts recommend owning a mix of AI leaders and other solid companies in different industries, just in case the tide turns. But one thing's clear, the AI trade isn't over yet. As long as other sectors lag, AI will likely keep leading the charge. Just be sure you're investing with your eyes open, not just following the hype. Before you go, let me know in the comments. Are you bullish on AI stocks, or do you think we're in bubble territory? Don't forget to like this video and subscribe for more breakdowns of the biggest stories in finance. And as we watch the market's next chapter unfold, remember, every boom has its risks, but also its opportunities. The future of AI and your portfolio could come down to which side you're ready to bet on.